The year is 1983. Over a game of poker, Bill Biggerstaff and Robert Mediaris came up with the idea for Silicon Valley Bank. Later that year, the first branch was opened in San Jose, California. Fast forward to the period of 2019 to 2022, and Silicon Valley Bank was one of the largest commercial banks in the United States, largely attributed to its major growth throughout the pandemic, during which it nearly tripled in size. Due to this large increase in the company's growth, the bank had a significant amount of deposits and assets on its hands. The company decided to use the overwhelming majority of these assets to buy treasury bonds, which historically have low returns but also low risk. However, as the Federal Reserve continued to increase interest rates to combat the soaring inflation at the time, Silicon Valley Bank's investment in the bonds became more and more risky. This is because investors could now buy bonds at more beneficial rates, so Silicon Valley Bank's bonds were declining in value. Around the same time, some customers of Silicon Valley Bank were struggling financially and began to withdraw large amounts of money from their accounts with Silicon Valley Bank. Silicon Valley was not prepared for this and ended up having to sell $1.8 billion worth of their treasury bonds in order to accommodate their clients' requests. Because of the location of Silicon Valley Bank, a large majority of their clients and depositors were startups and young entrepreneurs. While San Francisco is a big city, the network of these type of people is relatively small and close-knit. This is relevant because once a couple customers caught wind of what was going on with Silicon Valley Bank, word spread like wildfire throughout social media and on private communication channels such as iMessage and Slack about how unsafe any money held with Silicon Valley Bank was. Nearly all customers of Silicon Valley Bank were rushing to get their money out, and Silicon Valley simply did not have enough liquidity to grant their customers' wishes. On March 8, 2023, Silicon Valley Bank announced its $1.8 billion loss on its bond portfolio, along with plans to sell stock to raise an additional $2.25 billion. However, it was far too late. The situation climaxed the next day on March 9th, when the stock for Silicon Valley Bank's holding company, SVB Financial Group, crashed at the market opening. Silicon Valley Bank customers attempted to withdraw a total of $42 billion throughout that day. On March 10th, trading was halted for SVB Financial Group stock. Federal regulators announced that they were stepping in and taking over the bank. However, a buyer for the Silicon Valley Bank was not able to be found. 2 days later, on the 12th of March, federal regulators announced unprecedented emergency measures to combat the failure of the bank, in which all customers could recover their funds, even those that were uninsured. A high-profile bank failure like this one could reduce consumer confidence in the banking system and even in the economy as a whole, which is the reason that the federal regulators decided to grant all of the bank's customers their money. Fast forward to March 26th, and First Citizens Bank bought all of Silicon Valley Bank. All in all, customers of Silicon Valley Bank ended up worrying for nothing, as the federal government bailed them out. However, the big hit was taken by investors in Silicon Valley Bank, as the federal government cannot insure money that is invested into the stock market. SVB Financial Group was largely owned by institutional investors, and these are the companies that took the hit for Silicon Valley Bank's carelessness. The largest shareholders included companies such as BlackRock, Vanguard, and JP Morgan. The rapid decline and ultimate failure of Silicon Valley Bank taught the average person that their money will most likely be safe in any bank regardless of the situation, because the federal government will most likely save them. On the flip side, the situation taught banks that they can essentially be as careless as they want with their money, because worse comes to worse, the federal government will swoop in and save them if the situation gets bad enough.